Hi everyone, in this video I'm going to show you how to use channels in such a way that it helps you to extract the most information from the chart, which will significantly improve your trading as you know what to expect. It is recommended to know the basic structure in Elliott waves, which is an impulse, as in this video I'm going to talk about 3 different types of channels that are used in trending environments. If you do not know what an impulse is, please go to my YouTube homepage and check out the first video here in the playlist, Elliott Waves Beginner's Guide. Now, why is it important to know the basics of an impulse? It is important because pulling channels has to be done from specific pivots. If you use random pivots for channels, you're going to get random results, or as a bare minimum, you're going to have a lack of information, therefore a lack of expectation, which makes it more difficult to trade, and that is going to be reflected in your trading account. Knowing exactly what pivot to use for the different channels will significantly help your understanding of price action, what to expect, and therefore improves your trading. There are going to be 3 channels that I will be talking about. First of all, the green channel here is a base channel, the yellow channel here is a trending channel, and the orange channel is a ending channel. The reason why this is important is because you will see these colors in all of the examples that I have on the chart on different time frames. I will start in this video by pulling the channels in this example impulse here, so you know the pivots that you have to pull these channels from, and then we go to real live examples on the 50-minute time frame, the 1 hour, the 4 hour, the daily, and the weekly time frame. Let's have a look at my example impulse here on the chart, which is also the most common impulsive structure that you will find in reality, where your wave 3 is the longest impulsive structure, also carries the highest amount of volume in a bigger 1, 2, 3, 4, 5 wave structure. Your wave 2 retraced to the golden pocket. A deep retracement in 2 is common. Golden pocket is also a common target. Wave 4 retraced to the 0.382 Fibonacci, common for a wave 4. And also wave 4 is longer in time than wave 2, which is most common. And that is represented by the vertical line on the chart. That is a trend-based Fib time, taken from the start to the end of 2 to the end of 3, comparing the time of 2 with 4, and you can see wave 4 ends after the 1 to 1, and then we have our wave 5 common target here hit as well. So this is like a classical perfect impulse. Now, when you think about a new trend, the first thing you do is you pull a base channel, and a base channel is pulled from the start of 1 to the end of 2 to the end of wave 1. Now at the moment you can see we get a 3, 4 and 5, but in reality you have no idea that you're gonna get this price action, right? You pull a base channel the moment you identify a 5-wave structure inside a wave 1 here, because inside wave 1 we of course also want an impulse, so a 5-wave impulse in 1. We are then looking for a 3-wave corrective structure to the downside in wave 2, and we then expect another impulsive move to the upside. Now at that moment in time, we may not know if this move to the upside is going to be a wave C in, for example, a zigzag correction, being a 5, 3, 5, and then move down once again. Corrective structures tend to stick inside the base channel. They don't really move far away from the base channel. They tend to stay inside, and then eventually you move back towards the downside. But in an impulse, you want price to move out of the base channel on volume, because what you're looking for is a wave 3. You want to see a volume increase and you want to see an extension. You want price to move away from the base channel. Now after you then have your wave 3, you're going to be looking for a wave 4. And a wave 4 commonly retraces quite close to the base channel and also sometimes hits the base channel or moves back into the base channel. The only thing you do not want to see in a wave 4 is it to hit the lower trend line in this bullish example, or of course vice versa. In a bearish example, you don't want price to hit the upper trend line. But in this example here, we don't want price to move all the way down to the lower trend line of the base channel. Now, if we then have our wave 3, volume is increasing, we are breaking out of the base channel, that is the moment we are going to start pulling the trend channel. And the trend channel is taken from the end of wave 1 to wherever the end of your 3 is, which of course is changing as price moves up, which is the reason why it's called a trend channel, as it follows the trend. So imagine price broke out of the base channel and currently price is at this level over here. So I pull it from the end of 1 to the current high on the chart to the low, right? And we toggle on the yellow channel over here. So we do not yet have all of this information, right? This is unknown to us. So at the moment, what we are waiting for with a trend channel is we are waiting for a range to form that hits the lower trend line of the trend channel or breaks the lower trend line of the trend channel. And this gives us more confidence that the range that we are looking at is a wave 4, meaning we still expect one more move to the upside in a wave 5. Now, as price is moving to the upside inside your wave 3, you continuously pull the trend channel from the high of 1 to the end of 2 to then the new high of your wave 3, because what you're waiting for is you are waiting for a range to form that breaks the lower trend line of the channel, which is most common, just to give you a higher probability that the range that is forming is a wave 4. So price is moving up and up and up, and as it moves up, you will sometimes need to adjust your channel to make sure it is still connected to the correct pivots, and then eventually you get the high for your wave 3. So now your channel is pulled from the high of 1, high of 3, low of 2. And we start to see a range that breaks the channel, which increases the probabilities that the range over here is a wave 4, and we still expect another move towards the upside in a wave 5. And this is also the goal of the trend channel. The trend channel is following the trend inside a wave 3, and the probabilities are higher to continue towards the upside as long as you do not see a range forming that breaks the lower trend line of this channel, right? Because of course price doesn't move up in a straight line. It's going to move up, have a bit of a range, move up, bit of a range, up, bit of a range, but eventually you get a range that then breaks the lower trend line, and that is the moment where you say, okay, now the probabilities are higher that this is a wave 4 matching this wave 2, because we are pulling a channel from this green 1, right, to the green 3 to the green 2. So therefore we are looking for the green wave 4. Mind you, and this is where sometimes confusion comes in, inside your wave 3 you have an internal impulse, 1, 2, 3, 4, 5 wave structure, right? Now this impulse will have its own base channel, its own trend channel, and its own end channel as well, right? So we are now following the price action of the green count over here. So the moment you break this channel, we're looking for the green wave 4 and one more move to the upside in a wave 5. Now, the moment the channel is broken, you basically have enough information and pretty much you can then remove your trend channel. Which means that now you have again the base channel, because you can check how far price is retracing towards the base channel. Will it hit the base channel? Will it not hit the base channel? How far would it maybe move in the base channel? As mentioned, you don't want price to hit the lower trend line here. But it now also gives you the opportunity to wait for wave 4 to end. And if it does, we can start to pull an end channel. And that one is taken from the end of wave 2 to the end of your wave 4 to the end of your wave 3. And if you have a very, very extended wave 3, then you can also pull it to the end of your wave 1 instead, right? But in this example, we first start with pulling it to the end of your 3. And then over here, we then have, of course, again, channel taken from 2 to 4 to 3, and preferably your wave 5 is ending around the midline / the upper half of the channel. That is a common target for your 5. Again, if your wave 3 is very extended, then instead of pulling it to 3, you use it from 2 to 4 to then the high of your wave 1, right? And then you're also looking for price to end wave 5 somewhere in the upper half of the ending channel. So this is how you use channels in a trending environment using the correct pivots, which will give you so much more information about what is happening and also helps you with the expectation of what is coming next. It will significantly improve your trading results. People that do not know the basics of an impulse, that do not know how to use these different channels, are really missing out, and pulling channels from random pivots will eventually give random results, or at least a lack of information, which is going to hurt the amount of profit that you're actually able to make. That being said, let's now have a look at some real-life examples on the chart on different time frames. Here we have a 15-minute impulsive structure to the downside, 1, 2, 3, 4, a 5-wave move. The base channel is taken from the start of 1 to the end of 2 to the end of wave 1, and what we're looking for is wave 3 to break the base channel, preferably on an increased amount of volume, which is also what we saw here. What we are then looking for is a corrective sideways structure in a wave 4, moving back towards the base channel. Here we touched the lower trend line of the base channel, which is perfectly fine, and then we got a rejection and continuation to the downside, taking out the low, which is then our wave 5. The trend channel in this impulse 1, 2, 3, 4, 5 is taken from the end of your 1 to the end of your 3 to the end of your wave 2. What you're looking for is price to break the upper trend line of the trend channel, just to give higher probabilities that this is then your wave 4 matching your wave 2. Now price moved to the downside without many ranges. Eventually we make a low, range sideways, break the channel, probabilities increase for a wave 4, and we look for one more leg to the downside in a wave 5. The moment we then start moving to the downside, we can pull the end channel, and the end channel is of course taken from the end of wave 2 to the end of 4 to the end of 3. And here you can see that price found support on the lower trend line of this channel, after which we then moved out of the channel back towards the upside. This is the 1 hour time frame when price made the 56k low and continued towards the upside impulsively. Now this is an interesting example because I remember when price only printed this part on the chart over here and all of this was not yet printed on the chart, that some people counted this as a diagonal 1, 2, 3, 4, 5 correction continuation, while other people were counting this as a multi 1, 2, 1, 2, 1, 2 continuation. Now what I have done for the purpose of this video is put channels on the chart both for the diagonal idea as well as the multi 1-2 idea, and show you the differences but also the confluence between the different channels. So let's start with the diagonal idea, where this over here is then your wave 1. Over here this is your 2, and then you move towards the upside to finish the impulse. A base channel is then taken from the start of your wave 1, the end of your wave 2 to the end of your wave 1. What we are looking for is price to break out of the base channel, nicely done on some volume as well, and then eventually we have our wave 4 price section. We did get a retracement here. We never, however, hit the base channel, but that is not necessary, right? It's something you can see, but it's not something you have to see. Now then we have the trend channel. As price then moved out of the base channel, we pulled a trend channel on our chart, taken from the end of your wave 1 to every new high that is eventually printed on the chart. And I think this is a good moment for me to also show you in real life how this happens. So as price moves to the upside, you then create a high. At that moment in time, this is going to be your base channel from the end of 1 to the current high here to the low of your wave 2. Now you can see we made a range, we didn't break the lower trend line. We move to the upside and continue. Now at this moment in time, again, we build a range, we never break the lower trend line. Instead, we make another high. We pull it to the high here, right? Make sure that everything is correct. End of 1, end of 3, end of your wave 2. And now you can see we do break the base channel. So therefore, the probabilities here are highest. We are looking for a 4 that is matching your wave 2 and then one more push to the upside to take out the high. Now after the trend channel, we then have our ending channel, and the end channel is taken then from the end of your wave 2 to the end of 4 to the end of your wave 3. In this particular case, what we are then looking for is a wave 5 to the upside to preferably, of course, end somewhere around the midline, upper half. In this case, we didn't reach the midline. Happens. It's in the end trading. It's all probabilities. But wave 3 is, of course, quite extended as well. We can always pull it to the high of your wave 1. Right, and in a diagonal, remember, this is your 1, 2, 3, you're looking for your 4 and your 5, and then you can see that your wave 5 did end in the upper half of the channel, which is nice to see. Now the second example is then a multi 1-2, where we then have our 1, 2, and then another 1, 2, we continue to the upside. Here your base channel is taken from the start of your wave 1, the end of your wave 2, to the high of your wave 1. You can see price breaks out of the base channel, which is what we like to see. But we do not even come close with a wave 4 to the base channel. Again, it very much depends on the extension in 3, but you definitely don't have to come all the way back down to the base channel, right? Which we definitely didn't do here. Then we have the trend channel, which is taken from the end of your wave 1 to the end of your wave 3 to the end of your wave 2. We also break the trend channel here. Increasing probabilities, we're looking for a 4 and another 5. And then finally we have the end channel taken from the end of your 2, end of 4 to then in this case the end of your wave 1. And you can see price here moved into the upper half. If you would pull this channel to the end of your 3, then you can see we again missed out on hitting the midline of the channel. It's not a problem, right? It is still perfectly fine. This is the 4-hour time frame where price printed the 53k low and moved towards the upside in an impulsive structure. Now in this case, what we are looking for is a wave 1, 2, 3, 4, 5 wave structure, and inside your wave 3 we then have an internal 1, 2, 3, 4, 5 wave structure. But what we are looking for is the higher degree count, which is this over here. So in this particular case, we then have the base channel taken from the start of 1 to the end of 2 to the end of your wave 1. What we are looking for is price to break out of the base channel. Nice to see some volume as well. Eventually, we range, move up, we range and come down for your wave 4, hitting the upper trend line of the base channel, and then we move back for a wave 5. Now, as price is moving out of the base channel, we again have the opportunity to put the trend channel on the chart. Taken from the end of your 1 to the end of your 3 to the end of your wave 2. And again, I like to show you the example. What happened when price was moving to the upside is we pull it to every new high locally. First this one, and then this one, and then this one is over here. And you can see that this range never broke the lower trend line of the channel. So we are still looking, right? And then we made a high. So we're still looking for higher in wave 3. Eventually, we made the high over here. Right? And therefore, we then label this as a wave 4 because now we broke the lower trend line of the channel, increasing probabilities that this here is your wave 4 matching this wave 2, and therefore we're looking for one more move to the upside in a green wave 5. Now as price then moves towards the upside, we can of course here, right, we can then put the end channel on the chart taken from the end of 2, end of 4, end of 3. You can see wave 5 ended in the upper half of this channel. If you would pull it to the end of your wave 1 here, then you can see your wave 5 pretty much ended close to the upper trend line of the channel. This is also the 4-hour time frame where price made the 39k low and then moved towards the upside impulsively. And this example again is very interesting, mainly because it is not a classic nice impulsive structure, and there's a couple of extra things that you have to pay attention to. So in this particular scenario, we then have our wave 1, 2, 3, 4 and our wave 5. Base channel taken, start of 1, end of 2, end of your wave 1. We move out of the base channel, we come back to the base channel, and then we continue to the upside. Now, if you do not have all of this information, you can imagine that you could count this as a wave 3, as a wave 4, and you're looking for a wave 5 to the upside. However, if you then keep in mind the volume and what I said in the example all the way in the beginning of the video, where generally your wave 3 most commonly has the highest amount of volume, you can see that as price moves to the upside, the volume here also moves to the upside, and therefore from a probability perspective, the probabilities are higher that this structure here is still part of your wave 3, and this here is a lower degree wave 1 and a wave 2. So you're then looking still for another 3, 4, and then your wave 5. Now you can see that then your wave 4 moved towards the downside, moving towards the base channel. We never hit it, and then we get a wave 5. Now it's also interesting with regards to the trend channel. So taken from end of 1 to the end of 3 to the end of your wave 2. You can see that price moves up, but then breaks the trend channel. So at this moment in time, right, when you don't have all of this information here, you are likely labeling this as your wave 3. This is your 4, you're looking for your wave 5. But then as price is moving to the upside again, you check the volume. Hey, damn, higher volume, higher in a wave 5 compared to a wave 3 is very uncommon in Elliott waves. So therefore, the moment we had a volume increase here compared to the volume in wave 3, we therefore continue to keep this channel on the chart, as now we are relabeling the impulse. Instead of 1, 2, 3, 4, 5 and drop, we are now labeling 1, 2, 1, 2, and we look for 3, meaning this channel is still relevant as we are looking for a 1, 2, 1, 2, 3, 4, 5, 4, 5, and this 4 is then matching this wave 2. So that is what we're then waiting for. So price moves up, high amount of volume, small range, and then moves up again, and this is where price then broke this range over here, and then we moved up once more to finish the bigger impulse. Now just to show you how this looks as we are live, right? So we take it from end of 1 to then wherever price moves up, 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 up. We keep following price action with our channel as well. Now here you can see we break the channel. So okay, we're like, okay, we label this 4 and we look for one more high up in a wave 5. We take the high, we see an increased amount of volume. We immediately know, okay, higher probabilities, we're still in a 3. We keep this channel on the chart, or we put it again on the chart, and now we move up here and then we put it on this high over here, right, to of course the low, right? So then we have it from the end of your 1, right, to the end of your 3, to then the end here of your 2. We didn't hit the lower trend line, so we continue up, and now we do break the trend line, right? So that is how it goes in like real life, I suppose. And other probabilities are higher. This is a 4, and you look for price to take out this high one more time. Then finally, we have the end channel taken from the end of your 2, end of 4, end of your wave 3 here. And you can see that price ended in the upper half of the channel, hitting the upper trend line here. And in this case, if you would have taken, of course, the end of wave 1, so 2, 4, end of 1, it would have made, like the high would have been made above the channel. Now, most commonly, you will use the end of wave 3, only of course, if that doesn't like fit with the price action, you can move to a wave 1, but it gives you lower targets. This is the daily time frame where price made the 15K low and we move to the upside impulsively. In this particular scenario, we can count this as a wave 1, 2, 3, 4, 5 wave structure, and this move to the downside was labeled as a double zigzag, but that's not really too relevant for now, as we are focused on this structure over here. Now, as price then creates a 5-wave structure to the upside, 1, 2, 3, 4, 5, we look for a retracement and price to break the base channel, preferably again keeping an eye on a volume as well. And we have a volume increasement as price moved towards the upside, which is good to see, breaking the base channel. Now afterwards, we're then looking for a wave 4, moving back towards the base channel. In this case, we didn't hit it, and then one more move up. Then we have the trend channel. We break the base channel, we see some volume, we put the trend channel on the chart as well, taken from the end of 1 to the end of 3 to then the end of your wave 2. In this case, we then have 1, 2, 1, 2, 3, 4, 5, and then we have our 4 and one more 5. So what you can see here is that we nicely break the lower trend line of the trend channel, increasing probabilities. This here is your wave 4, matching your wave 2, looking for one more move to the upside to take out the high, which then is your wave 5. As price then moves towards the upside, this is your end channel, end of 2 to the end of 4 to then the end of your wave 3 here. And you can see price ending here in the upper half of the ending channel. This is the weekly time frame, and this now gives me the opportunity to talk about one very important thing, and that is that when you analyze a chart which has moved many hundreds of percent, in this case we had a 300% move towards the upside, the best thing from an Elliott wave point of view is to analyze that chart on the logarithmic scale. But the difference between log scale and the linear chart is going to be very big, which means that the channels that you pull on the log chart as well as the linear chart are going to have significant differences. And that is what I want to show you in this example. So first of all, we have the weekly time frame here on the log chart. So the channels are pulled on the logarithmic chart, with the base channel being from the 15K low to the low of 2 to the high of your wave 1. Your impulse is 1, 2, 3, 4, 5. That is what you're looking for here, the bigger trend. Now you can see that price then broke out of the base channel, not by much, but we did break out, and now we're back inside the base channel, hovering on the midline here, which is still perfectly fine. If price would hit the lower trend line here, then the most bullish scenario would change to a 1-2-1-2 continuation to the upside, where then at a later stage we are looking for price to make a wave 4-5, then another wave 4, which preferably comes towards the base channel, and then of course a final wave 5, and then the labeling would be 1, 2, 3, 4, 5, right? And then your lower degree would then be 1, 2, 3, 4, 5, right? And also for your lower degree impulse, you can then pull another base channel from the start of your blue one to the end of your blue 2 to the end of your blue one, right? It's the same thing, but that's maybe too much for this video. So let's just focus on what we have here, right? So at the moment, we are then looking for 1, 2, 3, 4 and a wave 5 towards the upside. Again, the moment we take the high, we keep an eye on the volume as well, because in a wave 5, we want to have a lower volume than a wave 3. The moment volume increases here, we can again be looking for an extension where this is going to be 3 and this becomes a 1-2-1-2. Now in this example, right, perfect, respected, perfectly fine, didn't hit the lower trend line, moved out of the base channel, came back in, all good. Then we have the trend channel, taken from the end of your 1 to the end of 3 to the end of your wave 2. And you can see that price ranged and broke the trend channel. Therefore, we are then looking for our wave 4 and a move up in a wave 5. And again, we also know that based on new information, we know if this is going to be a wave 4, wave 5 and a retracement, or if we look for continuation, right? But at least the probabilities are higher to still take out that high. And then we can also consider an end channel. If this is the end of your wave 4, the low at 49K, you take a channel from the low of 2 to the low of 4 to the high of your 3, giving you an estimation of a potential target for your wave 5, right? If we are looking for 5, that's an area of interest. If you would use wave 1, you can see your targets are going to be lower. Now, I like to use most of the time, and it's also recommended most of the time, to use the high of your 3. But arguably, at some cases, you will use the high of your wave 1. So this is the log scale. But now I will move from log to linear. Just keep an eye on what the channels do, right? So I click on this button, I turn logarithmic off, and you can see there's now a big difference in the base channel. There's also a big difference in the trend channel. Also a big difference in the ending channel. So let's have a look. I will put the channels on my chart, brand new for you. So base channel first. Start of your wave 1, end of 2 to the end of your wave 1. What we want to see is price to break out and continue, preferably of course again on a increased amount of volume. Now then what we're looking for is a wave 4 to come back to the channel, and then one more move up in a wave 5. We moved out of the base channel. An impulsive structure has a higher probability because a corrective structure preferably stays inside the channel, or you can dip out of the channel slightly, but then you want to of course move back and touch the lower trend line as well. That is your bearish alternative, by the way, which I should have said, I suppose, on the logarithmic scale. The moment you hit the lower trend line, of course your bullish scenario becomes 1 2 1 2 up in 3. Bearish scenario is that this is a 3-wave structure and you continue to the downside. I can go in a lot of detail on how you know if it's going to be bullish or bearish, but that's for another time, right? That's another time. I don't want to go too deep too quick. So we then have our base channel here on the linear chart. Then we also put the trend channel on the chart, end of year 1, end of year 3, end of year 2. Make this one yellow here. And you can see we broke the trend channel. Therefore, initially, we look for a wave 4 and a wave 5 to the upside. And then we pull the end channel from the end of 2 to the potential end here of your 4 at 49K to then the end of your wave 3. And then the midline here, the upper half of the channel, would be your main area of interest. Of course, you want price to take out the high as well. If we then look at the difference between the logarithmic scale channels and the linear scale channels, then currently I am on the log scale. This is a log based channel, and we can compare it with the linear based channel. And you can see that on the log scale, there's quite a lot of overlap. If I turn log off, still quite a lot of overlap, but there are subtle differences, as you can see. If we then go back to the log scale, then this is the log scale trend channel, and this is the linear scale trend channel. And you can see there is a massive difference between the two when you are on the logarithmic scale. Once I go to the linear scale, the difference is smaller, but there is still a difference between the two channels. If we then finally look at the end channel, this is the log channel here, the log end channel. Compare it with the linear end channel. You can see the end channel, the linear end channel, is a little bit higher on the log scale here, so there's a small difference. And if we go to the linear scale, then again, you can see there is a small difference. So using channels on a log scale or a linear scale will lead to some different targets, and sometimes they can differ very much, and sometimes the channels are quite similar, but you have to be aware of using channels on a time frame where price has moved hundreds of %. And this then leads, of course, to the question, what do I use? Do I channel on a logarithmic scale or do I channel on a linear scale? Now, on the higher time frames, when price moves hundreds of %, from an Elliott wave point of view, it is recommended to analyze the chart on the logarithmic scale. And because we use Elliott waves and the impulsive structure as a foundation of pulling these channels, it is recommended to then also pull the channels on the log scale. However, I always have a folder, so the moment I am channeling on a logarithmic scale, I will always make a folder in my object tree here with the linear channels as well. So I continue to keep an eye on the linear channels as well, but I primarily focus on the logarithmic channels. On the lower time frames, or if you go to other charts of other coins or whatever, and price on the lower time frames generally doesn't move hundreds of %, you just use the linear chart, no need to use log. You only want to use the logarithmic chart if price has moved hundreds of %, because you want to correct for the percentage difference. 1% at 15K is a lot different from 1% at 70K. So on a logarithmic chart, the chart corrects for that difference, and that is why from an Elliott wave point of view, we use log on the higher time frames when price has moved hundreds of %. So that would be the answer to that question. This is everything that you need to know about channeling trending structures, choosing the right pivots to extract the most information from the chart, which will significantly help your trading. The technique I used is also known as the Kennedy channeling technique, as Mr. Kennedy is the one that invented this channeling system in combination with Elliott waves, so make sure to check him out. Thank you for watching this video. I hope that it was helpful or valuable to you. Please check out the CVD indicator video, the best indicator out there in my opinion, or the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.